Hey everybody, it is Matt Dickin here from Strategic Wealth Designers, and thank you for joining Strategic Wealth Live, our weekly webinar series. Today we're going to be talking about the 3 keys to do now with everything that's happened in the economy and the stock market. So it looks like we have some individuals getting logged in. We're going to give them just a few moments to get settled and logged in. So in the meantime, we have been on the news quite a bit recently. So we've got a short little video clip that we're going to share with you of some of our appearances. And then as soon as that video is done, I'll be back with you and we will get the webinar started.
Yeah, he's our financial expert.
I wish my parents named me the expert.
Yeah, the expert. I mean, that would be all encompassing, right?
Yeah.
Well, we want to talk about interest rates. We just heard that the Fed's dropped rates again. And I know a lot of people think, yay, what does that mean?
Well, it's really interesting. The Fed uses interest rates by lowering them or raising them based on how they perceive the economy is doing.
Yeah.
So when they lower rates like they just did, oftentimes that leads to them thinking the economy needs a little bit of a kickstart, a little bit of a boost, because it's kind of struggling a little bit.
Okay.
A lot of people are wanting to refinance their homes, maybe start getting some larger loans that they've been putting off up to this point. When they raise rates, they're doing that because they think the economy is getting a little unruly. So what's really interesting about it is it kind of points to what the Fed and how they're viewing the economy actually is.
Well, talking about the housing market, where does that stand right now with the interest?
What are you telling your clients who have to be ringing the phone off the wall?
Well, I think a lot of people are shocked to the idea that the market moves in 2 directions, not just one. I think for a long time we've gotten a little complacent with the idea that the stock market only goes in one direction. So what I'm telling my clients right now, if what's going on right now makes your stomach churn a little bit, again, with the coronavirus, it might be what we call what we call black swan event, just something unexpected you just can't predict. If it's making your stomach churn right now, maybe it's a time to re-look at your allocations inside of your portfolio, meet with a professional, and really look and make sure you have the proper asset allocations. Again, if the market goes down a lot in one day and you get really uncomfortable or you don't like seeing those losses, you may want to shift some of those assets to more safer assets or building strong safety nets.
So there is no simple.
We have seen historic plunges and nothing seems to be easing fears. The emergency rate cut last week, just today the Fed pumping tens of millions of dollars into the financial system to try to ease this panic. Have you been surprised at the numbers, and where do you see the market going over the next few days?
Definitely a little bit surprised, but the market loves predictability, and it's been anything but that for the last few years. You know, we had tariffs, we had impeachments, now we have the coronavirus, then we had oil prices dropping, and so anytime something happens negatively in the globe, the market tends to react with a knee-jerk reaction. And so, of course, there's just a major sell-off, and I feel like it'll probably get a little bit worse before it gets better.
How low do you think things will go before we see a turnaround, and how long do you think it'll take?
Well, there's no way to know. I do think things will stabilize. I feel maybe when the weather gets better and the coronavirus starts to, subside, then that will help. But, there is just no way to know. What's the next thing? Elections around the corners. So.
Right. Always something.
Dustin Stanley with Strategic Wealth Advisors joins us to talk about finances. The Dow ended up over 5% higher, but that's not much when we look at what we lost yesterday. But Dustin, was this the right move? What is this going to do to help people at home? What should they take away?
I think the headline is great. I mean, $1 trillion stimulus into our economy, that's awesome. But if you think about the GDP of this country, that really buys us less than a month. I mean, we're over $20 trillion per year as GDP. So if everything shuts off and we don't have businesses running and people spending money, $1 trillion really isn't a whole lot of money.
The stock market is it's a forward-leading indicator. It's definitely pricing in a recession right now. Let's just assume we're going into a recession. What do people need to know to prepare? A recession means you're out of work. What can they do?
Well, I hope you've met with your advisor prior to these things happening. But if not, then it's not too late to make adjustments, make changes. That doesn't mean go out and sell everything off at a huge loss, but you need to make sure and have safety nets in place.
Another steep drop today on the market. How do we actually look at this from a financial and an emotional standpoint in terms of what this means for our money long term?
the key thing to do is have a plan. So if you know why you've made decisions, it's going to allow you to limit the emotions of how you react here. So I would say if you don't have a plan, you need to have a plan. You need to see an advisor. You can, if you're comfortable doing it yourself, you can come see us. We have an office in Fishers and Plainfield, but that will stop you from making highly emotional decisions. And if you've got too much risk, you can make some adjustments. You don't want to freeze. However, you want to be careful how you handle the situation. Not overly emotional, careful, smart adjustments based on what you own.
Now, Mike, I know you're hearing from a lot of your clients as well, and I'm sure a lot of clients are saying, are we...
Okay, hopefully everybody really enjoyed that. Like I mentioned, we're going to go ahead and get started with the presentation now. 3 key things to do now that we are in what's considered a bear market. Hopefully you enjoyed some of those news clips. We're fortunate to be on the news in Louisville, Lexington, Cincinnati, Indianapolis, and Denver, at least once a week, sometimes more often than that on the different affiliates that we work with. And I know we have some viewers here that this is maybe your first opportunity to get to know us. Others know myself and the firm very well, but I'll kind of give you a brief overview of my background and then jump into the 3 keys that we have that we want to share with you. Those that know my story know it very well, in that I got a very early start in the industry because I started out when I was just 18 years old. I was a freshman in college when I joined an internship program with one of the major firms in our industry. And I was fortunate that I started to excel at a pretty early age. And because of that, I was moved up into leadership and management positions within this company. And it seemed as I got higher and higher within the organization, I kind of felt like they would kind of sit me down and explain to me how things really worked there at the company. And what I kind of came to realize after several promotions, and after they gave me kind of the look behind the curtain a little bit, I kind of started to realize that a lot of the things that we were trained to tell our clients and a lot of the investments that we were told to go recommend to our clients had nothing to do with whether or not it was going to be in our client's best interest. It had everything to do with the fact of trying to maximize the revenues and the fees and commissions and things like that for the firm. And so I got pretty frustrated with that. I got into the industry to try and help people. So I decided that I probably needed to leave this company and go somewhere else. So what I did is I started to interview with all the major firms around town. And what I found was the problem I was experiencing at my original company wasn't necessarily unique to them. It's just kind of how the entire industry worked. And that got me pretty frustrated because I didn't want to operate in an atmosphere where I had things like quotas or pressure to recommend things to clients, whether they were in their best interest or not. So I actually contemplated and considered leaving the industry completely and going and doing something different. But fortunately, before doing that, I sat down and talked with my parents, and they said, you know what, Matt, they said, it seems like you enjoy what you're doing, seems like you're passionate about it. Rather than leaving a bad situation and maybe going to another company and having a similar bad situation, or rather than just leaving the industry completely, they said, why don't you just go ahead and start your own company? That way you can set it up right from the very beginning exactly how you want to. And so that's what I did. At this point, I was 23 years old when I started Strategic Wealth Designers. And I did it because I wanted to be an independent advisor, an independent firm, free to work with any company that's out there that's good for our clients. I wanted to be a fiduciary, meaning we have to act in our clients' best interest at all times. I'll touch a little bit more on that here a little bit later. And I didn't want to have all those problems or issues that you hear about and read about in our industry of having quotas and things of that nature. So we got the business going. Originally, it was just my wife and I working in the office. Eventually, we got busy enough to where we had to recruit my mom into the office. She had already retired, so we had to bring her in out of retirement to help out a few days per week. And again, if you fast forward to today, we now have a staff of over 30 individuals operating in our 5 different offices and looking to just help as many people as we possibly can have a secure, successful retirement. And so that, of course, brings us to where we are here today, trying to give you the information that I'm sharing with you as you're viewing this. because there's a lot of fear and concern out there in the marketplace within the stock market. Individuals aren't sure exactly what to do. Should they do anything with their investment? Should they wait until maybe things recover a little bit and then make some changes? So if you're a client of the firm, you know that we've been sending out some video messages to you pretty much on a weekly basis here recently. And the one that I sent out most recently had 3 tips that I'm covering with you here today. And I touched on them briefly in the video message that I sent out. And we just had an overwhelming response with questions and individuals wanting and needing more information. So we thought we would go ahead and just turn it into a full-blown webinar where we could educate both clients and others that aren't clients of ours, because I think that these are definitely 3 things that individuals, if they are close or into retirement, really need to be considering doing right now to take advantage of the unique atmosphere that we're in right now. So let's get started with that. I'm going to walk you through and move myself in and out of some of these slides so we're not blocking it. But let's recap a little bit of where we are right now. You know, there's been several economists that have said that because of the coronavirus and concerns and the shutdown that we've seen in major parts of our economy, that there are some projections saying that gross domestic product, the GDP, could drop by as much as 25% or more here in the second quarter. If that were to happen, that would be the largest single drop that we've ever seen in a single quarter. That would be bigger than what we saw in the Great Depression. What's causing that, of course, is, you know, we have unemployment beginning to really take off and rise. The most recent numbers we had from last week showed that we had over 3.2 million people file for unemployment, and that shattered the previous record set back in the early 80s of 695,000. So absolutely destroyed the previous record. Part of what's causing that is, of course, all the schools are closed. We have so many different events, sporting events and other types of concerts, things of that nature have been canceled or postponed. Hotels are, you know, typically I think an industry average is somewhere in the 60 to 70% range that they usually operate, being 60 to 70% full most of the time. Obviously, a larger percentage when special events are going on. I've seen some hotels down in the 5 to 10% range if they've stayed open. Many have closed. Of course, we know what's happening with restaurants only being able to do takeout and delivery. And then similar to what we're seeing with hotels, travel industry, you know, some reports showing where there's occasionally maybe as few as 3 or 4 passengers on some of the flights that are still taking place. So now we are officially, through what we've seen in March, down 30% from the high that we had reached just you know, in the previous month there in February. So it's literally the fastest bear market decline that we've ever seen. Again, worse than what we saw in the Great Depression by most factors or indicators that you take a look at. Some industries are saying that what we're dealing with right now is actually worse than September 11th and the financial crisis combined. It's kind of a perfect storm, and a lot of industries are saying that this is nothing like they've ever dealt with. And even again, going back to the Great Depression, that kind of came on a little bit slower. It was, you know, obviously started by the stock market decline in 1929, but, you know, it was kind of a gradual effect, whereas what we're dealing with right now feels like it almost kind of happened overnight. You know, certainly over just a month or so was pretty fast. As you see there, the average bear market decline usually lasts somewhere between 14 and 19 months. We've had a lot of different bear markets in the 100+ year history of the stock market. And usually from the top to the ultimate bottom, it's about a 14 to 19 month process. Whereas what we're experiencing right now, this particular bear market is just a few weeks old. And that's really concerning. And again, I'm going to touch on that here a little bit later in the presentation as to why that's concerning. And then on average, typically when we go from the top to the bottom, the average number of years it's going to take you to recover from that stock market decline is going to be 4 to 7 years. So we have the ability throughout the presentation here today, I'm going to be asking a few questions. And so I've got a question for everybody on this particular slide if you want to just type in your answer. And also, as I'm moving through the event here today, if you have questions about something that I'm mentioning, or maybe something that you have questions on that I didn't mention, then by all means, just submit your question. and we'll get it answered maybe here in the presentation, or we'll have one of our advisors from one of our offices follow up with you. But a question that I've got for you is, what year did we last see a drop as significant as what we just saw here in March? So when was the last time the stock market dropped by 30% or more? How many years, or can you name the year? So we'll give everybody just a moment here to kind of put their answers in, because I think some of you that have been following some of our commentary over the last few weeks, you'll know the answer already. So we've got some good answers coming in, and I'm seeing quite a few people getting it correct. So you are correct if you guessed the year 2008 was the last time that we saw a stock market decline of this magnitude. So the markets got a little bit rough in 2007, but 2008 was the big drop. And then the beginning of 2009 was a little bit rough, but by the end of the year, it had actually ended up turning into a positive year. So the last time we went through a bear market, it was right in that range of 14 to 19 months to get from the top to the bottom. So if we take a look, I'll get my picture out of the way here again, just giving some historical perspective. The worst bear market we've ever seen was during the Great Depression in the 1930s, where the market fell a total of 86% from the top until the bottom. And then the recovery time took a total of 16 years just to break even. So think about this. Say you put as an example, you put $1 in the stock market. You got your timing a little bit wrong. You were a little bit unlucky. You went through the big bear market and you waited 16 years to take your money back out of the market. Chances are you came back 16 years later and you had just $1 within the account. We've seen that happen a few times throughout the history of the stock market, but the 1930s is obviously the most memorable. The reason why I'm bringing this up is I'm not here to say that the stock market's going to drop by 86% again this time around. But let's say that earlier in March, you were down a total of 30% from where you were in February, from the peak. What will need to happen moving forward in order for you to break even or recover everything that you've lost so far, you're going to need about a 43% return. That typically doesn't happen overnight. That's, again, why it usually takes several years. But 43% is certainly possible. And that's not too big of a hole to dig your way out of, assuming that you've got the time to wait for it to bounce back. But if you take a look at our next bullet point here, where it says if you lose 50% of your portfolio, from the all-time high that we saw there in February, then what it's going to take is a total of a 100% return just to get back to even. So the way that works is, again, let's assume you had $100,000 invested in the stock market. Let's say it fell by 50% over the course of a year or several months. That obviously means that you fell back to $50,000. Sometimes people think that if the market goes down 50% and then up 50% the next year, we're back to even. Well, of course, that's not how math works, and that's the problem. That's the concern. If you were to lose 50% and then gained 50%, you would just be back to $75,000. In order to fully recover, you have to get all the way back to a 100% return, to get all the way back to $100,000. And so that's one of the main things that we are concerned about right now. Again, not saying that the market, there's no guarantee that it's going to fall a further 20 to 30% from where it is right now, but it has happened several times in the past, and it can certainly happen again moving forward. So if you have specific concerns about that, or if you didn't know that things could possibly get a little bit worse, what you can do is contact us. What we are offering everybody is a complimentary portfolio review. What you can do is click on the link that we just posted there right now, and you can schedule a time to talk with one of our advisors in each of the markets that we operate in. And then again, we're going to give you that offer again a couple of more times as we move through the event. But we are set up to do conference calls if you're more comfortable with that right now, or we can do Zoom or FaceTime meetings. Just let us know how you would like to talk with us. And again, we'll get you any answers to any questions that you might have. So let's jump into the first key that we have right here that I want to share with everybody. Right now, interest rates are at all-time lows. We've seen the interest rates, earlier, say over the last 6 to 9 months, interest rates had actually been going up a little bit. As the economy was doing so well, you were seeing interest rates really start to rise. But as we've gone through the concerns over coronavirus, obviously the Federal Reserve has responded and reacted really, again, in historic terms, and have reduced interest rates pretty dramatically. That's to try and stimulate the economy and make it easier for individuals to borrow money and hopefully go out and make large purchases. The thing that's concerning with that, though, is the fact that a lot of individuals within their portfolios, they're relying on bonds and, more importantly, bond funds in order for them to have some sort of a balance within their portfolio. A lot of individuals lost a good amount of money during the financial crisis of 2008. And so either on their own or through their advisors, they said, I don't want to go through that again. I want to have less risk in my portfolio. And what a lot of individuals have done is they've gone out and invested in bonds and in more likely scenarios, bond funds and bond ETFs. And so there's a lot of people that mistakenly believe that their portfolios are fairly conservative because they don't have 100% of their money invested in stocks. They've got some mixture of stocks and bonds, and maybe a traditional mixture of something like 60-40 or something of that nature. But the thing that individuals need to understand is, although we will agree that bonds and bond funds are safer than stocks and stock funds, they certainly are not safe. They have lost significant sums of money in the past, and the conditions are right now in order for that to happen again. Because if you take a look at it, we've got a little teeter-totter here on the screen. The way it works is, as interest rates start to go up, bond yields and bond prices will start to go down, driving the value of a bond or a bond fund lower. Of course, the reverse of that is true as well. So as interest rates go down, bond yields go higher, and that drives the value of bonds up. So even though we're in a bear market right now, if you have any money invested in bond funds, they may have performed pretty well, because as we started to get into the volatility that we've seen starting there in February, interest rates started to go down, and that started to drive the value of bonds and bond funds up. So far, it's maybe an asset category that's performed pretty well for you. But where we are right now is, again, historical lows. We're at or near zero with interest rates, and that means that they can only go one direction, and that, of course, means they're going to start to go higher at some point in the future. So one of the things that we did at Strategic Wealth Designers recently is we had a pretty good run in the bond ETFs that we own, but we actually sold those. We locked in the profits, and we have sold off those bond positions because we know in the not too distant future, hopefully we get out of the crisis that we're in right now sooner rather than later. And when that happens, interest rates have to go higher. And as they start to go higher, what will happen is bonds and bond funds are going to lose a lot of value. I don't want to get too technical with you here today. Even if that were not to happen anytime soon, you have to understand that a lot of corporations are, again, they're kind of in a shutdown mode of operation right now. They're not generating anywhere near the revenue that they thought that they were going to generate. So in the not too distant future, we're anticipating a lot of corporations are not going to be able to meet their debt obligations on their bonds. And so you're going to start to see some defaults. And again, that will impact anybody that owns those bonds, and it will impact anybody that owns bond funds. Because where this idea comes from that bonds and bond funds are safe is this. The way a bond works is if you buy it and you hold it to maturity, even if it loses value because interest rates go higher, as long as you hold it to maturity, you're going to get all of your money back. Now, unless they go into some sort of a default, you're going to collect your interest. And at some point in the future, maybe a year from now, 5 years from now, as long as 30 years from now, depending on the bond, when it matures, you get your original principal back. And so that's where the idea that a bond is safe comes from. And again, maybe certain bonds, you can make that argument. However, a lot of people that we work with, they don't own individual bonds. For diversification, what they've done is they've gone out and invested in a bond fund, which I will agree helps add some diversification. But what you have to understand is that with a bond fund, they don't act just like bonds, meaning that there is no maturity date. So when a bond fund loses money, the fund manager doesn't typically hold those bonds to maturity. He or she is in there trying to generate or fix the lack of a return. So they're buying and selling and trading bonds often, especially when things get volatile like they are right now. So the reality is when you lose money on a bond fund, there's no maturity to get your principal back. You've just lost the money. And then you have to sit around and wait and hope for it to come back up in value. And so we've got one of the bullet points here on your screen is an average. So it depends on how risky your bond fund or maybe your bond ETF is. And again, ETF stands for exchange traded fund. Depending on how risky or how conservative it is, but on average, for every 1% increase in interest rates, a bond fund is going to lose on average about 8% in value. And where we are right now is we're at or near zero, right? And the historical norm for interest rates is right at 5.5%. So again, another question that I have for you that you can submit to us, if you think you know the answer, you can do the math pretty quickly, is if interest rates were to get back to historical norms, what type of loss is that going to be on bond funds in particular? Just if you think you know the answer, if you can do the math pretty quickly, go ahead and key that in, and we'll see if anybody guesses it. So we're seeing some good guesses there. And yep, so it looks like several correct answers coming through. If you guessed right in the 40 to 44% range, then you are correct. Now, again, I'm not saying that interest rates are going to boomerang back to 5.5%. I think that they'll go up slower. It'll take several years to get back there. But as interest rates are going higher and higher in the months and maybe years to come, what that's going to do is that's going to start to generate some pretty significant losses for individuals on their portfolios and their bond funds, which is an asset category that a lot of individuals mistakenly believe is completely safe. And like we already said, we believe bond funds and bonds are safer than stocks, but they certainly are not safe. Right now is the correct time to be looking at some alternatives to bonds and bond funds, because again, you've had a pretty good run on them, but that's not something that's going to continue to last as we move forward. About the only exception that I can say to that is if you own U.S. Treasuries within your portfolios. We have some within our portfolios at Strategic Wealth Designers, and so even though recently we've sold off almost all of our bond positions, again, if you're a client of the firm, you're going to see that we have continued to hold U.S. Treasuries because, again, they act a little bit different from your traditional corporate bonds. And so we do think that that's an okay asset to hold for right now. But if you own bonds and, more importantly, bond funds within your portfolio, you definitely want to have a game plan for is how you're going to handle it when interest rates start going higher. And you really want to do something sooner rather than later. Don't wait for interest rates to go higher, because if you wait till then, it'll be too late. So do something now with any bond funds you might hold within your portfolios. Okay, let's go to the second key. I'm going to remove myself here again so you can see the full screen. The next key that we have that we really think individuals need to be taking a look at right now is maybe moving all or part of the portfolio over into something that will at least be a little more secure than what you've been in the past. Again, most of our clients that we work with are retired already or soon to be retired, meaning they plan on retiring within about the next 10 years. That's who most of our clients are. We do work with a lot of our clients' children and grandchildren, but most of our clients are probably age 50 plus, something of that nature. And so if you're in that category, one of the things that we've noticed over time is that more and more individuals, as the market was going higher over the last several years, started to tell us that they considered themselves to be maybe a little bit of more of a moderate investor as opposed to being a conservative investor. And so there's been a little bit of extra risk people have been taking within their portfolios over the last few years than maybe what they really should have been taking. But now that the market has pulled back a little bit, some individuals are now saying, well, we don't want to make any changes right now. We want to wait until the market gets back to even, and then we'll make adjustments. We want to get back to where we were there in February, and then we'll change some things. And I think that is really, really risky right now to take that type of approach, and we would advise highly against that. The reason why is because we're not really sure if we've reached a bottom in the market yet. If you take a look at some of the economic news we've seen so far, yes, unemployment has spiked a little bit, but we're at the beginning of getting bad news. Wait until corporate earnings come out. Unemployment's going to continue to go higher and higher. It looks like the social distancing and shelter in place in your home may be extended further and further. And the longer that this goes, the more detrimental that's going to be to companies, and obviously that's going to impact the stock market and your investments. So I guess the point we're trying to make here is that it is not too late in order for you to lock in what you've earned. Because again, if you take a look at it and put it into perspective, if you've been in the market and the investments that you have right now, say for 5 or more years, you probably still have some pretty nice gains. I know that we're not necessarily as high as we were in February, but relatively speaking, we're still in pretty good shape. So one of the things we're asking people to consider doing right now is do what we refer to as a lateral move. And what we mean by that is you can go into investments that are going to be lower risk maybe than what you have right now, or certain types of investments will have a little bit of a safety net that you can put underneath the portfolio or underneath the accounts. So if the market goes any lower, you've kind of drawn a line in the sand, if you will, and saying that's it. I'm not comfortable losing anymore. I'm not happy with what I've seen it go down so far, but I'm not at a point yet where I cannot recover from this. But if I lose even more, maybe I won't be able to recover. If you find yourself in that type of scenario, it's not too late to make some changes and do what we refer to as a lateral move. And what we mean by that is some of the positions that you own may be a little bit lower, at least down from their all-time highs. You can move out of some of those assets, but you can buy into other asset categories that are maybe low as well. So you're selling low, but you can buy low and maybe move into an investment that won't be as volatile. And you can put a floor underneath the portfolio. So again, you don't lose any more as we start to, in the weeks and months to come, start to get the real economic numbers, which more than likely will not look good. And in a moment, I'm going to go over a couple of different options that you have of things that you can consider to move assets into in order to put a little bit of a safety net or a floor underneath your portfolio. But again, bad bear markets like we are supposed to be going through right now, typically what they will do, if you look at them historically, they'll move back to where they were typically as a point value back to about 10 years prior. So when the stock market hits its all-time high and then you enter a bear market, usually over time, it slides all the way back to where it was as far as the values 10 years ago. Now, it's no guarantee that this one will work out that same way, but that's just historically what we've seen. Depending on how aggressive you've been in your portfolio, where you are today is probably back to where you were maybe 3 or 4 years ago. So there's a pretty good chance that things could fall back even further from where we are right now. So we would recommend doing some sort of a lateral move, and don't think that it's too late to make any adjustments. What we've got here is that, the second to last bullet point here on the screen is where this idea that when the market drops, you don't want to change anything, because if you do, you're locking in your loss. Where that idea comes from is if you have an investment and it's fallen in value a little bit and you sell that investment while it's low and just move the money to cash, well then yes, of course, you have locked in your loss in that scenario. That is not what we are recommending. We're recommending right now, if you want to take less risk and you don't want to worry about your money as much, then do a lateral move. Don't sell it all off and move it to cash, but maybe sell some of the assets that are low, but you can buy into other assets that are low as well. And that's the lateral move. And where this is really vitally important is if you have money in what's referred to as a dormant account, because we work with a lot of individuals. Some don't want to have any risk at all within their portfolio. And then others say, hey, you know what, I want most of my money to be fairly safe or conservative, but I don't mind taking some risk with the rest of it. Well, in that situation, there are good accounts to take risk in and then not so good accounts to take risk in. And the difference is whether the account is active or dormant. So to define these, an active account is any account that you're putting money into on a monthly basis. So it could be maybe a retirement plan through where you work, or just any type of investment account. If you're adding money to it monthly, that can maybe be an okay time to take some risk, because what happens on an actively funded account is you get to take advantage of the volatility in the market like we've seen here recently. So although when the stock market goes down, like it has here this year, you're not excited about it, but you're still actively contributing. You're still putting money in. So you're going to buy more shares at a lower price that will help you recover more quickly when the market starts to rally and rebound. So in an actively funded account, it may be okay to have some risk if you're okay having risk. But where you typically want to avoid taking risk is in what's referred to as a dormant account. Now, a dormant account is any account that you're not adding money to on a monthly basis. That's the key. So it could be a previous employer's retirement plan that you never rolled over, or maybe you did roll it over, but you're no longer contributing any money to it. Then if you're not putting money into it on a monthly basis, those accounts are considered dormant, and that's typically where you want to avoid having risk. So it's okay to have some risk in the portfolio. We just got to know when to use it, when to avoid risk as well. And if you understand this concept of active versus dormant, then this will help you out a lot moving forward. This is a concept that is misunderstood by a lot of individuals. Even a lot of financial advisors don't quite understand this. So that's why in my book on retirement planning, I literally spent an entire chapter talking about this issue because it's so misunderstood by so many different people. So a word of caution right now, in particular, for anybody that maybe unfortunately has lost their job, or maybe you have a loved one or a friend that has lost their job, their 401ks or 403bs, whatever it may be, those accounts are now considered dormant because you're no longer adding any money to them on a monthly basis. Now is the right time to maybe take and look and roll those accounts over to something that may be safer because you're not able to take advantage of the volatility. And in particular, because of everything that's going on right now, I have to mention this. You know, we say often that if you're not at your previous employer, we don't think that your money should be there either. And the reason why is because when individuals have money invested in a 401k, a lot of times the options that you have to invest in are restricted. You can just pick and choose the mutual funds that your employer has picked. Because of that, a lot of times the fees and expenses are higher on a 401k and a 403b than what they would be on an IRA if you were to roll it over. Another big issue is the fact that an IRA is better for your heirs and beneficiaries to inherit than what a 401k is. They just have more flexibility, more options. And then the last reason, and probably the biggest reason why I'm saying this right now, is a lot of people don't realize this is how it works. But let's say that you have a 401k through an employer and you were recently let go. Unfortunately, part of downsizing and just, you know, it is what it is with everything that's going on in the economy. One of the things a lot of people don't realize, though, is if that employer that you just were laid off from, if they were to file bankruptcy for any reason, then the assets that are within your 401k are basically frozen until the bankruptcy is over, and then you can do what you want to with them. So let me paint a scenario for you. So you don't lose the money, okay? They can't seize the money. It's nothing like that. But while the bankruptcy is going on, you cannot roll that money over anywhere. You cannot take any withdrawals. You can't do any loans, and you cannot make any changes to what the money is invested in. So we saw this happen, unfortunately, to some individuals through the financial crisis of 10 plus years ago, where they worked for a particular company because things weren't going well. They were laid off. They were downsized. They had a lot of money in their 401k, but then the company filed bankruptcy. Those individuals were not able to access the money to live on, which some of them needed to do that. They couldn't, and they weren't able to make any changes. So as the stock market continued to go further and further down, they wanted to move the money to something that was going to be less risky because the accounts were now dormant. They were not actively contributing to them. They wanted to reduce the risk, and they couldn't until the bankruptcy proceedings were over. And in some cases, of course, that takes years. It's rare that it just takes a month or so. It usually takes years. So this, again, is why we're such big believers that if you're not at your previous employer, we don't think that your money should be either. So again, if either yourself or maybe any of your loved ones that you work with, if they're needing to talk with someone about this, again, you can click on the link that we have here on the page, and you can schedule a meeting to talk with one of our advisors, again, either on the phone, or we can set up a Zoom or a FaceTime meeting, whatever is going to be most appropriate and most beneficial for you. But if you have money at a previous employer or have loved ones that have money at a previous employer, you've got to get that rolled over to an IRA and do something different with those assets, especially in the environment that we're in right now. a couple of different options that you can take a look at to kind of wrap up this key number 2 that we're covering of how do you put a safety net in underneath your account. One option, of course, is to work with one of the different index annuities that are out there. We as a firm, we've worked with index annuities for years. They're not all created equal. There's some good ones. There's some bad ones. Again, being an independent firm, we can work with any of them that are out there. But to just hit on some of the highlights here as to why we like them is any money that's invested within the accounts is going to be safe, meaning both principal and growth, once it's locked in each year, can never go down. You don't lose any value. So you can have growth with safety. And if you need to in the future, of course, you can turn these accounts into guaranteed income for life that you cannot outlive. With some of the best designed index annuities, again, there's all different varieties of them, but you typically have little to no fees. Some of our favorite accounts have no fees whatsoever. Sometimes fees can't be avoided, but most of the time we can go with an account with no fees. Some of the accounts that are out there will offer upfront bonuses. So some of them right now are still paying bonuses as high as 7%. Not going to be appropriate for everybody, but some of the accounts will pay an upfront bonus as high as 7%. So again, let's say you roll over $100,000 as an example. You start out with $107,000 right from the very first day. Let's say you roll over $300,000, then that means you would have $321,000 right up front, very first day. This can sometimes, if you've had some losses within accounts, can sometimes help offset some of those losses, and then again put in a floor to where both what you have put in plus the bonus plus any growth can never be lost. Now, under a microscope, every investment anywhere that you put your money is going to have good things and bad things about it. With the index annuity, of course, you got to have some sort of a time commitment. These range anywhere from 1 to 10 years before you can pull all of your money out of the accounts. And you usually have limited liquidity along the way, usually right at about 10% of whatever the account is worth is what can be withdrawn each year during your time commitment. Then once you get to the end of the time commitment, you can do whatever you want. Another option, option number 2, is to go with risk managed volatility funds. So we always say it's impossible to time the market because you have to be correct twice. You got to know when to get out and when to get back in. So these can be a nice alternative. It can keep you invested in the market with reduced risk because they do use a volatility algorithm. We'll keep it very high level here and very simple. Basically what it does is it helps you reduce volatility while still being invested in the market. If it were to go up in value, hopefully it does later this year, and this will allow you to participate in that. Again, the downside with these types of accounts is you are still going to have some risk. It is reduced a little bit, but you're going to have some risk, and then typically fees are going to be a little bit higher as well. So again, if you have any questions on any of that, you can check or click the link that we have here with the offer to set up a time to get together and discuss things with us. We'd be happy to answer any questions that you have on those 2 options, as well as a few others, but I wanted to hit on the 2 most popular options that we're working with right now. So 2 things that can be done to put a little bit of a safety net or a security blanket underneath your accounts. Let's take a look at the third key and item that we want you to consider doing right now. And it is taking a look at where tax rates are currently. They're at historic lows, and they're set to go up in the not too distant future. Unless Congress gets together and renews some of the tax cuts that were passed a couple of years ago, then tax rates are automatically set to go higher. So again, this is going to be an area where I've got a question for you, where you can go to the box and submit the answer. Right now tax rates are at historic lows. They've been much higher in the past. Does anybody know what the top tax rate is anybody has ever had to pay, historically speaking, here in the United States as far as federal income taxes go? So today, highest tax rate for most individuals is right at 37%. But does anybody know how high it has been in the past? Let's take just a moment and see if we've got any guesses. Okay, so a couple of good guesses coming in here. So 60, 70%. I've got one at 80%. Those are pretty common guesses, but most people are usually pretty surprised to know that the highest tax rate anybody has ever had to pay was right at 94% in federal income taxes. It happened for 2 years during the 1940s. And so, of course, we've got the graph here on the screen showing the top marginal bracket every year, going all the way back to 1913, which is when we started paying income taxes under our current system. So the reason why I'm bringing up this third tip is consider moving money in tax-deferred accounts over to tax-free accounts. Consider doing that right now. Sometimes individuals look to maybe do Roth IRA conversions or maybe convert to other tax-free types of accounts. And if you've ever considered doing that or you're thinking of doing that in the future, now is a great time to do that, because everybody knows that we recently passed the $2 trillion coronavirus stimulus plan, and we don't have the money to pay for that. We were already running about $1 trillion budget deficit. We know, depending on the day, we're at 20 trillion plus in debt before this package was passed. And how are we going to pay for that? Well, we're going to have to pay for it at some point in the future in the form of higher income tax. Those that have followed us for a while know that we believe that some of the unfunded liabilities that we have, if you take a look at changing demographics within the country, tax rates are going to have to go higher because we just don't have the money to pay for Social Security, Medicare, Medicaid in the future and meet all of the promises that we've made without raising income taxes on everyone. Not just the upper class or the top 1%, but it's something that literally everyone's going to have to pay in at a much higher tax rate. And again, that was before we passed this particular stimulus plan. And of course, Washington, D.C. is already talking about maybe doing a fourth stimulus plan because, of course, this was the third. So we're encouraging everyone right now to consider converting all or part of their accounts over into maybe a Roth IRA or other tax-free options. Before you do this, though, we do recommend that you get some sort of a tax analysis done. And this, again, is an area that we can help you. We can run a tax analysis to see how much you should convert now and maybe how much next year or the year after that. We rarely ever recommend individuals convert everything all at once. But again, if you have assets that have gone down in value 20 to 30%, now may be a good time to go ahead and make the conversion, because you'll pay taxes on the reduced amount. And then when things ultimately do hopefully recover and rally and rebound, all of those gains can ultimately be income tax free when you structure this properly. The most recently passed Secure Act that took effect January 1st of 2020 makes doing these types of conversions even more important than what they were in the past, in particular for your heirs and beneficiaries. Because again, those that follow us know that we've talked about the Secure Act already, but just to hit on what I'm talking about here today, one of the really bad parts of the Secure Act, there's some good things, but one of the bad things that they did was they took away the ability for heirs and beneficiaries to withdraw money from IRAs and 401ks and 403bs when they inherit them from their parents or grandparents. They took away the ability to withdraw those funds over the course of their lifetime. Now individuals have to withdraw those funds over just a 10-year period. So they have to completely deplete the IRA or the 401k that they inherit over a 10-year period. And of course, that will come out, whatever they have to withdraw each year comes out as ordinary income. And that goes on top of whatever income or salary they and maybe their spouse already have. So it can throw them in a much higher tax bracket, can cause problems when they go to apply for student loans and things of that nature for their children and maybe your grandchildren. So it causes all kinds of problems. So you really want to take a look at converting as much as you can. You usually can't convert 100% of it, but try and get as much as you can moved over into tax-free accounts right now, while some of the assets are a little bit down in value. And again, one of our advisors can help you with an analysis to see how much it makes sense, and then we can actually project and show you how much it may save you in taxes over time, and then how much it may save your heirs and beneficiaries in taxes over time as well. Okay, so again, we've gone over 3 different things to consider doing now. We certainly want you to consider doing something different with your bonds, and more importantly, bond funds, whether it's bond mutual funds or bond ETFs. Take a look at putting some sort of a safety net underneath your portfolio now. Even though you may have lost a little bit in value, we maybe haven't lost as much as we can. So try and put a safety net underneath the portfolio now before it's too late. And then while things are down a little bit, consider taking a look at converting some of the assets over into tax-free accounts. If you would like, again, if you have additional questions, you could submit those questions to us here today. Or if you would like to schedule a meeting with us, again, we're set up to do conference calls or Zoom meetings. We are an essential business, so we do have the ability, if you do want to meet face-to-face on a limited basis by appointment only, we are doing some of those meetings, but most individuals right now prefer either a conference call or Zoom, and we're set up to do that. I'll just point out a couple of last things here, and then I'll put up how to get in contact with us again. We are a fiduciary firm, and we recommend, whether we can help someone or not, you definitely want to work with a fiduciary. A fiduciary has to act in your best interest at all times. Most advisors are held to what's called a suitability standard, meaning they just have to recommend things to you that are considered suitable, whereas ourselves, our advisors, we have to always recommend what is in the client's best interest. And we have to prove that when we go through audits with regulators within our industry. You also want to work with somebody that's an independent advisor and not tied to any one company. Again, you want to have every available option within the advisor's toolbox. So we are not tied to any one company. We are free to do business with all of them. That makes sense for our clients. Again, not all advisors are able to do that. In particular, if they work maybe for a bank or a different firm, they may be restricted to which companies they are allowed to work with. And usually they are restricted to only work with certain companies because those are the companies that are going to pay their firm and themselves the most amount of money. So you want to work with someone that's independent and free from those types of issues. And then last, again, if you're retired or soon to be retired, you want to make sure that you're working with someone that is a true distribution specialist. Retirement planning goes into two different types of phases. You have the accumulation phase that we go through as we're kind of trying to build up the nest egg. And then at some point when you get closer into retirement, you go into the distribution phase, which basically says, hey, I've got this nest egg. I've worked my entire life for it. How do I now turn this into an income that I won't outlive? I need to keep up with and outpace inflation, but I don't want to take a ton of risk with it because I don't have the luxury of time to make up for large market drops again. When you start to be concerned about those types of things, you know that you're in the distribution phase of your retirement plans, and you want to work with a specialist who does nothing but distribution planning. There's a lot of firms that can help you accumulate your nest egg, but we are one of a handful across the country that are 100% distribution specialists. That's pretty much all we work with every single day, 5 days a week, over the last almost 2 decades now since I started the firm. So if you want a second opinion, if it's not from us, make sure whoever you go to and whoever you are talking with meets that criteria. You want a fiduciary, independent advisor who is a distribution specialist. So again, to schedule a meeting with us, just contact us. We'll set up a time to talk. Continue to watch your inbox because we're going to be coming out with additional webinars in the future as part of our Strategic Wealth Lives webinar program. I hope everybody has learned something. If there was a question that you have that I missed, just key it in and we will be happy to get together with you and answer any questions that you might have. Okay, great. Thank you for tuning in and I look forward to seeing everybody at some point in the future. Thank you.